Earlier this month, we explained how to double dip for income by reinvesting dividends and writing covered calls against dividend-paying stocks. While that's a sound, sometimes lucrative strategy, it's nothing compared to the success you can have writing covered calls against your positions in decidedly more volatile stocks, such as Tesla. The first thing we need to understand is something called implied volatility, which is one of the most important elements of covered call writing, particularly if you're in it to maximize income generation. Sounds complicated, but it's not. Implied volatility is just a forward-looking assessment of the market's expectation of how much a stock's price will move. A higher IV means investors anticipate considerable movement in a stock. A lower IV indicates the market thinks a stock will remain in or around its current range. Our partner Bar Chart provides useful IV statistics. Let's take a look at Tesla as an example. Note its current IV of 76%, which is the average IV of the nearest monthly options contract. Generally, the higher the IV, the more expensive the option premium. This is a good thing if you're selling covered calls because when you sell one, you collect and keep the option premium no matter what happens with the underlying stock. As the Tesla November 18, 2022 options chain shows, IV increases the closer the strike price of the call gets to the stock's current market price. The more in the money the call, the green area, the higher the IV. The more out of the money, the lower the IV. IV also tends to be higher around earnings, particularly ahead of reports where investors expect significant price movement on the results. Tesla is reporting on the 19th this month. This dynamic can benefit the call seller but often burns the call buyer. If IV tanks shortly after earnings, it will likely take the value of the options premium with it, even if the stock moves higher. And while this can also present a risk to the covered call writer, the risk of having your underlying shares called away. The bottom line is this: covered calls are a fantastic way to generate income, but they aren't risk-free. Because Tesla releases earnings Wednesday, we'll revisit this topic after the company's report and look how writing covered calls would have worked out.